A massive crash may be coming to Bitcoin soon. Hey guys, what's going on? Jeb here, and in today's video, we're going to be talking about how Bitcoin has just broken below some massively important support, how the Fed may be bringing even more rate hikes in the next few months, and of the three major cases for bullishness over the course of the rest of this year, only one really remains relevant. In today's episode of The Climate of Crypto, I'm going to break down for you exactly why Bitcoin's price may be in trouble and what you need to do about it. So without much further ado, let's go ahead and dive right on into it. Let's start with the facts. The SEC has come down hard against Binance and Coinbase. And following that crackdown, Bitcoin has entered a major downtrend and lost over $2,000 in value. Following that drop, Bitcoin has gone through the largest correction it's seen in nearly 3 months, falling back down to $25,000, all the while breaking the massively important support level at $25,236, breaking below the 200 daily exponential moving average, which serves as a critical bull market uptrending support zone. On top of that, Bitcoin's also broken below the 200 weekly exponential moving average, which is one of the most important support levels that Bitcoin can possibly find. Furthermore, Bitcoin's broken below this uptrending level of support right here that's been defining the uptrend that we've been in all year. That has been broken as of last night. Last but not least, the entire Bitcoin market has now entered a 3 black crows formation, which typically signals either the beginning or just the middle of a downtrend. If this was just the beginning, we might have a lot further to go to the downside. If this is the middle, Bitcoin's already dropped $5,000. Another $5,000 might be in order. Let us not forget the massive Bitcoin future CME gap down here at $20,000, which is $5,000 lower than where we are right now. In breaking below $25,236, Bitcoin has begun one of the largest downtrends that it has witnessed in a very long time. It's not fully confirmed yet, but if Bitcoin does stay below $25,236, stays down here in this 24.1 to 25.2 region for too long, then Bitcoin is heavily at risk of entering into a massive downtrend. That makes sense. All of those levels of support weren't broken for no reason. These levels of support were broken after the Securities and Exchange Commission filed charges against Coinbase, Changpeng Zhao, and Binance. It stands as a reason the entire cryptocurrency market right now would be down as much as it is, below $1 trillion in total market capitalization, for example, considering the amount of fear, uncertainty, and doubt that the SEC's onslaught against Bitcoin has brought. Let's make no mistake, that is the single largest attack that Bitcoin has probably ever witnessed, and something that we're going to have to battle likely for years. But there's another reason why Bitcoin is in critical danger of dropping below that support at $25,236. And it has everything to do with Wednesday's FOMC meeting. You see, on Wednesday, June 14th at 2 p.m., the effective federal funds rate was paused, and it remained at 5.15%. The concern is that in the press conference just after, Jerome Powell seemed to make it pretty clear that up to another 50 basis points worth of rate hikes could be coming over the course of the rest of this year. Much of this likely has to do with the fact that even though CPI dropped by 0.9% on Tuesday, that was mainly driven by energy being down 11.7%, which is only down that much because fuel oil and gasoline are down 20 and 37% respectively, meaning that inflation on gasoline and fuel oil coming down has led to the major drop on CPI. That's likely not going to continue because in just a couple of months, the worst of the inflation in United States gasoline prices will be rolling off of the 12-month moving average, and that will no longer be bringing down CPI. Instead, consumer price index is going to have to come down based on food coming down and all items minus food and energy coming down, which are a lot more sticky. With that understanding that inflation is starting to get a lot more sticky, the 18 policymakers at the Fed are not so inclined to go ahead and pause rates that easily. As with any committee, you have different parties, and in the FOMC, there are 18 policymakers, and some of them are doves, believing that we should pause at least for several months to see if we're going to enter a recession and see if we actually need more rate hikes. But there's also other members of the FOMC, the Federal Open Market Committee, that believe we should go ahead and do another 50 basis points of rate hikes to ensure that inflation does come down to target 2%, that the Fed is getting far more serious about right now than they have been in the last decade. Jerome Powell, being the chairman of the Federal Reserve and the chairman of the Federal Open Market Committee, is trying to appease both sides of the aisle. So far, they've paused the effective federal funds rate, but that's not likely to continue. At this point, Jerome Powell has come out and said that there very well may be up to another 50 basis points of rate hikes with some pausing in between. We didn't see that coming because the Fed has never done that. If they've ever gone on a hiking cycle, they have always done all the hiking at once and then paused and then dropped the rates several years later. But for the first time in nearly 40 years, it looks like that may be reversing, and it looks like we may have a series of pauses, then hikes, then pauses, then hikes over the course of the rest of this year that could lead to another 50 basis points worth of rate hiking if the inflation does not come down as aggressively as those hawks on the FOMC are hoping for. The reason that's important for you as the Bitcoin investor is because the EFFR, the effective federal funds rate, was one of the 3 biggest bullish factors that Bitcoin had going for it right now. We had 3 bulls. Unfortunately, one remains. What are they? Well, first and foremost, one of our bulls was Consumer Price Index. People were excited to see CPI data coming out because good, CPI is going to come out. We're going to see a drop. And when CPI data releases and inflation goes down, then the retail investor is going to look at that and they're going to think, okay, our economy is becoming more stabilized. The average retail investor sees Bitcoin and cryptocurrency as a speculative, almost tech stock that they're going to put their leftovers in. It's where they're going to put their more risky part of their investment portfolio in. So they're only going to put a little bit in that portfolio, their cryptocurrency portfolio, if they believe that the economy is stable. So with inflation coming down, the hope was that the retail would come into crypto because they believe that the economy is more stable. That bull is honestly no longer running. And the reason for that is twofold. Number one, CPI dropped by 0.9% in 1 month, which means we kind of ate our whole cake at once and now we've got an upset stomach. And two, people are realizing that the retail trader and investor that would be investing in cryptocurrency are going to be so much more turned off by the SEC's attack on Coinbase, CZ, and Binance than they would be turned on by lowering interest rates, that it's no longer really a concern for them because the retail that would have been coming in because of lowering CPI is not going to because of the SEC's attack. That bull, unfortunately, seems to be largely out of the equation. The second bull was the bull of looking forward to an effective federal funds rate pause. Up until Wednesday at 2 p.m., we were all excited that good, there may be an effective federal funds rate pause. It's going to be great. We're going to be done, and we can look forward to 6 months from now there being drops. Unfortunately, that's not what Jay Powell said at the press conference on Wednesday. Instead, he outlined this scheme where the Fed is very, very serious about getting down to target 2%, which means bringing inflation down by at least another half of what it is right now, and they will do just about whatever it takes to get it there as quickly as they possibly can, which means that while we were happy and excited that a Fed rate pause was probably going to happen this month, what we didn't see coming is that Jay Powell was going to tease that there are probably more hikes in the future, meaning two things. Number one, it means that this big event of a Fed rate pause that everybody was looking forward to is now over. Imagine you go on a trip. Let's say you're going to Disney, you're going on a carnival, whatever it is. The entire time that you're waiting for that to happen, you're excited. Yay, Christmas is coming. December 26th comes, and I tell you what, that's probably the worst day of the year, isn't it? Because this thing you've been looking forward to this whole time, it finally happened, and now what? That's what the market is feeling right now relating to this effective federal funds rate pause. Instead of being excited about something happening and having hopium and having FOMO even, excitement, now the market's thinking, oh, well, that didn't do a whole lot. Instead, we dropped $1,000, by the way, and now we don't know what's going to happen next. So there's now been this FOMO of good, an effective federal funds rate pause is coming, been completely replaced, not just with nothingness, but with FUD, that no, actually, we probably will see more rate hikes. But just to make matters worse, we don't know when it's going to happen. We don't know if one's going to happen next month or the month after or the month after that. We also don't know if one's going to happen at all or if there's going to be even more than that because the Fed has broken their trend of hiking rates at every single meeting. And now we don't know if they're going to do one off, one on, one off, one off, or two off, one on, two on, one off, or what they're going to do. So now the FOMO of a Fed rate pause has been replaced with the FUD of more Fed rate hikes, and we don't even know when or how they're going to come. The third bull, and the one that remains off in the distance that gives us some hope, is that the Bitcoin halving is coming. But honestly, guys, right now, people are so scared about the SEC's attack on crypto, and they're also so shaken up about what Jay Powell said yesterday with not having any certainty as to whether or not an effective federal funds rate hiking is coming next month, the month after, or the month after that. All of this to say, the CPI data information, the gasoline prices information, the effective federal funds rate information, the data I showed you on the charts earlier, all of this comes back to one clear action step that you guys need to take. And it's very simply as this. You need to heavily consider your current exposure to cryptocurrency. What do I mean? Well, keep in mind, possibly the largest bearish story in the history of Bitcoin ever occurred last week. That being the SEC filing charges against Coinbase, Binance, and CZ, and making it very clear that this war that they've been staging for has now started. June 5th was the beginning of the war for the independence of crypto, when the attack against Binance and CZ began. In light of that, we need to realize that something fundamentally changed on that day. Retail and institutional investors outside of the cryptocurrency space now looking into crypto are going to be far more apprehensive of getting into this crypto environment than they would have before. Let me put it like this. If you are a real estate investor, are you going to want to go and invest your money in a war-torn country, in real estate? Is that where you're going to want to go and invest your money? Probably not. You might give money to help in humanitarian or Red Cross or relief, or you might support one side of that war or the other or whatever it may be. but you're probably not going to go and buy an apartment building in a city that's being bombed. Similarly, there's a war going on in cryptocurrency right now, and a war that needs to be fought, and a war that we need to stand our ground for, and a war that we need to defend the principles of cryptocurrency over, because there's an attack not just on unregulated securities. There's an attack on the very identity of cryptocurrency going on right now. This is an ideological thing, whether the SEC wants to admit it or not. But at the same time, as investors, can you really blame the retail or the institutional traders and investors for not wanting to get into cryptocurrency right now because they're not sure which side's going to come out on top? Crypto, led by Coinbase, CZ, and Binance, or the SEC, led by Gary Gensler? We'll see. We got to give it a few months to see which side is going to get the upper hand legally. So with that in mind, and with the fact that two of those big bulls, two of the three, have kind of fallen off the radar in relevance, that being CPI dropping and the effective federal funds rate pausing, we need to heavily consider how much exposure we have to cryptocurrency. In two ways. Number one, you may not have enough exposure to cryptocurrency. It may be that you're not in crypto at all right now, and you need to stack some money on the sidelines and say, you know what, I've got investments here, here, and here. I have mutual funds, rates, I own real property, etc. But I want to get into crypto. I want to have 2% of my investment portfolio in crypto. 5, 10%, whatever it is. So I'm going to put some money in a high yield savings account right now, or in treasuries. There are 3 months treasuries. And I'm going to say, I'm going to make 5% of my money while I hold it, but I'm going to keep it on the sidelines liquid so that I can deploy into Bitcoin if it drops down to $20,000, which is very possible at this point. Maybe you need to take heed as to the amount of your net worth you have in cryptocurrency because you are not invested at all, or you want to be invested more. Now, number two, and this is the one that will probably be unpopular with some of you guys, but I don't always speak for the sake of being popular. In fact, I try not to most times. I try to tell you what you need to hear, even if it's not what you want to hear. You may need to consider that you have too much of your net worth in crypto. Do you have 50% of your net worth in cryptocurrency? Do you have 30% of your net worth in cryptocurrency? Do you have 70% of your net worth in cryptocurrency? How much of your net worth, let's say your net worth is $250,000, do you want to have $75,000 in crypto? Could you really stand to lose that much? Realistically, you're not going to lose all of it, but could you stand to lose 80% of that if something were to happen, especially if you're mostly invested in low cap altcoins? You probably couldn't. If you've got 55% of your entire net worth in cryptocurrency, then you should consider diversifying, whether the SEC is attacking Bitcoin or cryptocurrency or not. Just in general, you should consider diversifying. But especially with the attack that's going on in crypto right now, you need to especially heavily consider that maybe it's time to liquidate some of your assets, some of your real estate investments in that country that just had war declared on it. If you're a real estate investor and you've got 90% of your investment in rental property in Donbass and it's February 24th, maybe you should liquidate some of that somehow and invest in like Hamburg, Germany, or somewhere a little more peaceful for right now. Help the Ukrainians, sure, but maybe put your investment somewhere they're safer. You may have already been overexposed and in too risky of a position in cryptocurrency, and maybe the SEC attacking crypto, maybe the Fed hiking rates even more is your warning that you need to diversify a little bit more and not be so exposed to cryptocurrency. I think a major drop is probably coming, and so if you do rediversify, it may be that Bitcoin drops $5,000, you sold some right now, and then you invested into a treasury that's a 6-month and is 5.3%. You make a bunch of money over there and you turn around and put it right back in. You effectively shorted the market and you made more Bitcoin in the long run. But I would just heavily encourage you, your action step, your takeaways, that you need to consider how much you have invested in Bitcoin right now in crypto. To wrap it out, let me be very clear about something. Bitcoin is technology that absolutely needs to be stood for, and there is a very good reason that it went to $500 billion. It was not because it was the newest widget. It was not because it was the newest gizmo. It's not because it's a fidget spinner. It's not because it's popular. It's not because it's cool. It's because it empowers financial sovereignty. That is why Bitcoin has been worth over $1 trillion in the past, because that is something that resonates with the heart and soul of a human, to not be in financial bondage because a government put them there. Bitcoin is founded on principles and virtues that need to be defended and stood for, even if you don't have a penny invested in it. It is an asset class. It is a revolution in the way that the world operates that we absolutely need to defend. So when I caution you about how much you have invested in Bitcoin, I want you to know I am not, and I will never turn my back on what Bitcoin was founded on, because we need to be able to have sovereignty and authority over our finances, and one of the ways we do that is not being financially bound to the powers that be in the United States government and the United States dollar. Bitcoin absolutely needs to be stood for, and it absolutely should be fought for. But your investment portfolio maybe you need to consider how much of that you have in the war-torn space that we are in right now. I hope you did enjoy today's video. If you did, make sure to hit that like button, subscribe to the channel, hit that post notification bell so you won't miss a single episode of Climate of Crypto. And also make sure to sign up for Lux Algo using coupon code JEB30, that's JEBB30, for 30% off at checkout to get access to an incredible technical indicator, which very well soon may be giving us a hugely important signal on the weekly chart. Before I go, guys, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video.